Hello friends, hope all of you and your families are safe during these times. In the next few minutes, I'm going to take you through the key events of the recent past and Kotak Mutual Fund's view on equity markets. What a year FY 2020-21 has been for investors. From the sharp drops in March of 2020, where there were cries of despair, to the swift rise and the significant surge in the last few months, where everything that seemed to go right went right for equity investors. March was a month of significant volatility. COVID-19 second wave in India, the stimulus in US bringing along with it global inflationary expectations moving up and taking with them the prospect of higher yields, the strengthening of the US dollar, etc. In between all of this, there was a margin call on a large global fund seeing forced liquidation in global markets, as well as a blockage of the Suez Canal and its impact on global trade. Let us examine some of these in greater detail now. First, the COVID-19 second wave. Just as we started celebrating the onset of vaccination in India in February, the rise in COVID-19 cases, especially in a few states like Maharashtra, Gujarat, Karnataka and Kerala, point to the fact that one has to continue to remain vigilant against the virus. While vaccination drive scale-up has been impressive, given our large population, the current scale of daily vaccination implies that we are many months away before a significant amount of our population can be vaccinated. The swift rise in COVID-19 infections has raised prospects of reduced economic activity, although one hopes that it doesn't repeat in even more stringent lockdowns that we saw last year. After two very strong quarters of India Inc. profits, one will have to wait and see if these restrictions in economic activity will impact the momentum or not. For sure, the YOY comparisons of quarterly profits for the next two quarters are very easy given the adverse base that we saw in the last year, but we need to watch out for earnings revisions in the months ahead to gauge momentum of earnings traction. Secondly, global inflationary trends and yields. Over the last few months, many commodities, be it industrial, energy, or agri-commodities, have spiked up as a sudden demand impulse triggered by stimulus across the world, as well as normalization of economic activity, have surprised global supply chains. The stimulus passed by US last month further raises prospects of very strong demand, which may further feed through inflationary expectations. Given this, bond yields have risen very strongly in most developed markets. Big swings in yields and currency markets brought fears of the taper tantrum that many of us witnessed in 2013. While few emerging markets like Turkey, Brazil and Russia witnessed significant fluctuations, India has been relatively less impacted, both in the bond yields as well as in currency markets, thanks to large reserves that we have added in the last year. Thirdly, on flows. FIIs, as we all know, have been very large purchasers of Indian equities in the last few months. In March, however, the intensity of purchases have come off quite meaningfully. One needs to see that over the last year, the last fiscal year, has been very strong for FII flows into India, and therefore some of this moderation needs to be seen from that context. While the longer term attractiveness for Indian equities still remains, in the short term, FII flows may be impacted, especially in a period of global turmoil. All these factors have meant a minor moderation in equities in March. The correction that we've seen in the last few weeks have been broad-based, with both global factors as well as restrictions due to the COVID-19 second wave dominating the concerns. However, compared to most emerging markets, Indian equity markets have significantly outperformed in March, giving a sense of both the longer-term potential and sustainability of growth prospects in a relative sense. While there are many Indian savers who kept the faith in Indian equities despite all the volatility that they saw last year, they've been well rewarded for their perseverance. But there are many who've stayed in sidelines, and with interest rates and alternate asset classes earning lower rates, we would advise investors to look at the bigger picture rather than being focused on index levels. Markets, for sure, have definitely risen too soon too fast. And given the confluence of events since March of last year, they will take time to digest all these developments and flows. The Indian economy will normalize, corporate profit pools are rising, and despite the recent rise in yields, interest rates are still low and are unlikely to go to levels which Indian savers have traditionally experienced in the past. Given this, a disciplined asset allocation with a focus on longer term goals is imperative, and equities continue to form an important avenue to fulfill longer term goal obligations. Be patient, investors, and do remember time in the market is more important than timing the market. Thank you and stay safe.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.